All right, so good evening and welcome once again to tonight's section. We'll be talking about IAS 36, IAS 36 impairment, IAS 36 impairment, IAS 36, that is impairment, impairment. Impairment. Okay. Of assets. Let me add impairment of assets. Impairment of assets. All right. So, what is impairment? What is impairment of assets? So, impairment of assets is basically when an asset loses its value, right? So, when an asset loses its value. So, this can be as a result of internal or external factors. So, that is basically impairment. What is the objective of impairment? What is the objective of impairment? Objective of impairment. So the objective of impairment, the objective is to set rules, to ensure that assets of an entity are not carried, let me, sorry, are carried at not more than their recoverable amount. At not more than their recoverable amount. It's not more than their recoverable amount. It's not more than that. So that is the key objective of IAS 36 impairment, is to set rules to ensure that the assets of an entity are carried not more than their recoverable amount. Not more than their recoverable amount. So it's basically saying that assets should not be carried in the books more than it can offer, right? More than it can offer. Assets should not be carried in the books more than it can offer. But then it should be carried below, or it should be carried exactly it is able to offer. So that is impairment. That is impairment. So IAS 36 applies to all assets other than, so it doesn't apply to, so does not apply to the following. It does not apply to the following: inventories. Does not apply to the following inventories, which is the IAS 2, right? IAS 2 Construction doesn't apply to construction contract. Construction contract, which is the IFRS 15. It does not also apply to deferred tax assets, deferred tax assets, deferred tax assets. And then assets arising from employee benefits, assets arising from employee benefits. Assets applying for employee benefits, which is the IAS 19. Can also talk of investment property. It doesn't investment property. IAS 40. Investment property. Investment property. Property, which is what? IAS 40. IAS 40. IAS 40. What else? Then we cannot. It doesn't also relate to IFRS 5, which we talked about in our last meeting. So that IFRS 5 is what? Non-current assets held for sale. Non-current assets held for sale, right? Non-current assets held for sale. All right. So now we said that assets should not be carried more than their recoverable amount, right? More than their recoverable amount. So an asset is impaired if its recoverable amount is less than what? The carrying amount. So an asset is impaired. It's impaired if it's impaired what? If its recoverable amount is less than what? It's less than the carrying amount. It's less than the carrying amount. Carrying amount of that asset. Of that asset, or a cash generating what? Cash generating unit. Right? So what then is the recoverable amount? What then is the recoverable amount? All right. So the recoverable amount is what is higher. It's higher of what? The recoverable amount is what? Is the higher of the net realizable value. net realizable value, NRV. Is the higher of the net realizable value. So what is the net realizable value? The net realizable value is what? Fair value. The fair value less cost to sell. Fair value less cost to sell. Less cost to sell. And what? And the value in what use? And the value in use. And the value you use. So the recoverable amount is the higher of these two, right? So that is the recoverable amount. So the higher of these two seen as our recoverable amount, value in use, and then the fair value less cost to sell. But then what is the value in use? What is the value in use? The value in use, the value in use is determined by, how do we determine the value? It's determined by what? It's determined by estimating what? The future cash flows. Estimating future what? Cash flows. Estimating future cash flows. So the cash flows can be inflows and what? Outflows to be derived from the use of what? The assets. You derive from the use of what? Of the assets. Of the assets. From the use of the assets. The use of the assets and its ultimate disposal. And its ultimate disposal, and then applying a suitable discount rate, applying a suitable discount rate, applying a suitable discount rate to this cash flow. To this cash flows. Today's cash flows. Today's cash flow. Alright, so that is basically the value in use, right? So the cash flows related to financing activities or income taxes should not be what included, right? Cash flows relating to financing activities or income taxes should not be included. All right, so let's take some example. Let's take an example. Okay, so let's take a question and then solve it together. So this is question 1. Someone should take us through. All right, someone should read for us.
Illustration 1. The following information related to three assets. Carrying value 100, 150, 120. NRV 110, 165, and 100. Value in use 120, 130, 90. Required. Determine A, the recoverable amount of each asset, and B, the impairment loss for each asset.
Okay, so for this question, so that is illustration 1. Okay. So they asked to find what is there to find the recoverable amount. So what is the recoverable amount? What are the recoverable amount states? Recoverable amount is what? We know that recoverable amount is higher of what?
NRV and value in use.
So NRV and then the value in use. The value in use, right? So we've been given this is the NRV and this is the value in use. This is the NRV and then this is the what? Value in use. All right, so for A, B, and C, what is the recoverable amount?
The
recoverable amount for A is what?
A is 120.
A is 120. Why?
Because between the NRV and the value in use, the value in use is the higher one.
So yes, so it means value in use is higher than the 110, and that makes it the recoverable amount. Of the B, what is the recoverable amount?
130.
So 130 is the recoverable amount. Why? Because it is higher than the NRV of 125. 200 it is cheap. And then the C is what?
100.
100, right? So 100 is our recoverable amount. You can even close your eyes and write the answer. All right. So that is A for you. Then B. B says to find the impairment loss for each of the assets. So what is the impairment loss for? Impairment loss. Impairment loss. So for A, what is our impairment loss? For B, what is impairment loss? For C, what are impairment loss?
The A, there is no impairment loss.
Okay. So the A, there is no impairment
There is
loss.
no yes.
Why are you saying there is no impairment loss?
Because the carrying amount is less than the recoverable amount.
How do we get impairment loss in the first place? How do we get impairment loss? How to get impairment loss?
Carrying amount minus.
All right. So the impairment loss is carrying amount minus what? The recoverable amount. Recoverable amount, right? So if the carrying amount is higher than the recoverable amount, then there should be impairment loss. And if the recoverable amount is more than the carrying amount, what do we have? If the recoverable amount is more than the carrying amount, what do we have?
No impairment loss.
So there is no impairment loss. There is nothing like impairment gain. So if the recoverable amount is higher than the carrying amount, then there is no impairment loss. That is it. So with this, impairment loss for A is dash, right?
Yes.
Impairment loss is dash. What of B? B, comparing the carrying amount of 150 and then the recoverable amount of what 130. What is our carrying amount?
20.
20 for B. What of C? Carrying amount of 120 and then recoverable amount of 100.
20.
C. This question is just testing your basic knowledge, understanding. So that is it. Let's continue with the question number 2. Let's continue with the question number 2. Question number 2. All right. So question number 2. All right. So let's go through the question number 2. Reader, please take us through question number 2.
Illustration 2. An entity owns a property which was originally purchased for 300,000. The property has been revalued to 500,000 with a revaluation of 200,000 being recognized as other comprehensive income and recorded in the revaluation reserve. The property has a current value of 460,000. The recoverable amount of the property has just been estimated at only 200,000. What's the amount of impairment and how should this be treated in the financial statements?
Okay. All right. So with this, what is the cost? Can I see this, right? So what is the cost of the assets? What is the cost of the assets?
300 for them.
Yes, so the entity owns a property originally purchased at what? 300,000. So 300,000. And then that it was revalued to what? 500, right? So revalued to 500. Revalued amount is 500. Basically, we know that there is a revaluation surplus. Even without reading the question being stated that it's 200. That is a revaluation surplus. Revaluation was surplus. What happens? Being recognized as other comprehensive income and recorded in relation in the revaluation reserve. The property has a current carrying value of 460,000, right? 460,000, but the recoverable amount of the property has just been estimated. Estimated to 200,000. 200,000. So if that is the case, then what then is our impairment loss? So the carrying amount is what? carrying amount 460,000. Then the recoverable amount of what? 200.
200,000.
Recoverable amount is 200,000. So what is our impairment loss?
260,000.
Impairment loss is 260,000. 260,000. So how would this be treated in the? As to what is the amount of the impairment and how it should be treated in the financial statement? So how would this be treated in the financial statement? How do we treat in the financial statement?
Ew.
Yes. How do we treat it in the financial statement?
At the balance sheet side, you subtract it from the net book value, the carrying amount.
Okay. So in terms of debit and credit, what should we do? Okay, so you with respect to P and L first. So P and L, what do we debit? We debit P and L. Sorry. We debit and let me add OCI. So what do we do to the OCI? We debit the OCI with what? With the revaluation surplus, right?
Yes. Yes.
Of 200,000. Sorry. Of 200,000. Then what happens? Do we debit P and L? We debit P and L. So we said that we have impairment loss of 260, and there is a revaluation reserve of 200. So this revaluation surplus of 200 will go and reduce the impairment loss of 260. If it reduces this impairment loss of 2, so it is 200. So to reduce 200 out of the 260. So what will be the impairment loss now?
1,000.
Hello, someone is making noise. Okay, so let's continue. Hello, did I just close the? Wow. Okay. So impairment loss of 260, and we are having a surplus. So the surplus will reduce the impairment loss by 200,000. So how much will be the loss in the books? How much will be the loss in the books now?
60,000.
60,000. Where would the 60,000 loss go? The 60,000 loss will be debited to where? To the P&L, right?
Yes.
It will be debited to the P&L. And then what do we credit? If we debit the 60 to P&L, what will be credited? Yes. From here, what do we do?
Okay.
We have debited the P&L. So let's, under the asset side, what do you think will happen? We'll credit the assets. with the impairment loss, right? This impairment loss will go and reduce the asset value, right? Hello, are you with me?
Yes.
So it will go and reduce the impairment value. Yes. So this is how it will be treated in the financial statement. This is how it should be treated in the financial statement. All right. So let's quickly go to example 3. All right. So example 3, illustration. Okay. So please read for us.
Illustration 3. On 31st December 2021, an entity noticed that one of its items of plant and machinery is often left idle. On this date, the asset had a carrying amount of 500,000 and a fair value of 375,000. The estimated cost required to dispose of the assets at 25,000. Yes, if the asset is not sold, the entity estimates that it would generate cash inflows of 200,000 in each of the next 2 years. Assume the cash flows occur at the end of each year. The discount rate that reflects the risk specific to this asset is 10%. Required. A. Discuss the accounting treatment of the above in the financial statements for the year ended 31st December 2021. B. How would the answer to part A be different if there was a balance of 10,000 in other components of equity relating to the prior revaluation of this specific asset?
Okay. So I think even before we continue with the 3, let me see. Okay. So okay, so let's have it. So when it's done, then we look at this theory. So what is today on the first demand? An entity noticed that one of its items of plant machinery is often left idle, right? What is it? Discard the accounting treatment of the above financial statement for the year ended 31st December 2021. So plant and machinery left idle, right? On this day, the asset carrying amount is 500,000 and a fair value of this, right? So the estimated cost required to dispose this of the 25. All right. So what is the carrying amount of the asset? What is the carrying amount? The asset had a carrying amount, right? What is the carrying amount?
500,000.
500,000.
500,000, and then so now carrying amount of 500,000 and the fair value is what 35. The estimated cost to if the asset is not sold, the entity estimate that it will generate cash inflows of 200 in the next 2 years. Assume that the cash flows occur at the end of each year. The discount rate is what specific 10%. All right. So now that we know our carrying amount, we have to compare this carrying amount to the recoverable amount. So what is the recoverable amount? What is the recoverable amount? Recoverable amount is what? Higher of the word net realizable value and the word value in use. Okay. So now, what is our net realizable value? What is our net realizable value? Net realizable value is what? Is the fair value less cost to sell. Is the fair value less cost to sell. So what is our fair value from the question? What is our fair value from the question? And a fair value of how much?
325,000. 325,000.
25,000. 325,000. 3,000. Okay, 1,000.
Oh.
And then okay. Then less cost to sell. So less minus. What is the cost to sell? Cost to sell is how much? The estimated cost to required to dispose of the assets are what? 25. So less 25,000. And what do we have now? So we are having how much?
300,000.
300,000. So now we are done with the net realizable value, and we look for the value in use.
What
did we say the value in use is? We said that the value in use is what? Is determined by estimating future cash flows. The cash flows can be inflows or outflows. To be able to derive from the use of the assets. And also applying a suitable discount rate. Who is making noise?
How do I know?
And also
One is the
using a discount rate.
Oh, she's missing. Yeah. Oh, course it is.
Someone is making noise. I have to kill the person. Okay. So we saw that with the value in use, you'll be given cash flows, inflows and outflows, and then you have to discount it using the discount rates. So using the discount rates, okay. So I believe you remember. So let's check and see whether it is a single cash flow or it is a uniform cash flow, annuity. So we said that if the asset is not sold, the entity estimate that it will generate cash inflows of what 200 in each next 2 years. Is it a single cash flow or it is an annuity?
An annuity.
It's an annuity, right? Because in each of the next 2 years, so that makes it annuity. Equal cash flow within equal intervals. So that makes it annuity, right? So the value in use is basically we finding the present value. So we'll be using the present value formula or present value annuity, right? So what is the present value annuity? What is the present value annuity? It is C, I guess 1 minus 1 plus R exponent minus N all over what? All over the R. All over R, right? So that is the value in use. So 200,000. So what is the amount? Yes, is it 200? Yes, 200,000 each year. So 200,000, 1 minus 1 plus R. What is the rate? The rate is what? 10%. 10%. So 0.10. The number of years is 2 years. And all divided by the rate, which is 0.10. Bracket close. So what is the present value or the value in use?
247,107.438.
Sorry, please come again.
347,107.438.
33
347
347
107
107
yes please point 438
107 4
point yes 38
438.
yes please.
Are you all getting the same answer?
Yes please.
Okay. All right. Since you are all getting the same answer, then I assume that it's correct. So now we said the recoverable amount is the higher of the two. So which of them becomes a recoverable amount? Which of them becomes which one?
The value in use.
The value in use become a recoverable amount. And note, usually when you compare value in use and then the net realizable value, usually the value in use is higher. From what I've been saying, usually value in use is higher. That is for what I've been saying. So you can even run it to the nearest whole number. So nearest whole number will be what? What is the nearest whole number? That is
35,000. 45,000.
45,000. Hey, ayo. All right. So this is the recoverable amount. To compare it to the carrying amount of what is the carrying amount? What did you get for the carrying amount? Carrying amount is 500,000. So what is our impairment loss? Impairment loss is how much?
152,893.
152,809.
93.
Okay. All right. So if that is the case, this is our impairment loss. So how do we treat this in our books?
You said all this one.
Sorry?
Please, I have a question.
Okay.
Please, can you please explain again why it's annuity?
Why is annuity? So it's annuity because look at it. Annuity